Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning and welcome to today's webcast, Tax Planning for Senior Care Organizations. I'm happy to introduce today's moderator, Rob Grannum, and our speakers, Jason Thompson and MaryCaitlin Willcuts. Rob, I will now turn the line over to you.
Great, thank you. Thank you everyone for joining our webcast this morning. My name is Rob Grannum. I'm a tax partner at Moss Adams and the Washington practice leader for our firm's healthcare group. I work extensively with clients in the healthcare industry, including long-term care, hospitals, medical groups, individual physicians, providing strategic business and tax services. And I'll be facilitating today's discussion along with our presenters, Jason Thompson and MaryCaitlin Willcuts. Jason provides federal and state tax services to a variety of individual and business clients with a particular emphasis on clients who own, operate, invest, and manage all types of real estate assets. Jason concentrates his practice on tax issues involving tangible property and renewable energy credits and incentives, and maintains a deep and in-depth knowledge and understanding of the laws relating to cost segregation and research and development credits. He spends quite a substantial amount of his time in the long-term care space providing real estate incentives. MaryCaitlin Willcuts has been in public accounting since 2010. Within our state and local tax services team, MaryCaitlin's primary focus is the Work Opportunity Tax Credit, or the WOTC credit. She currently manages the Moss Adams Max Credit Program, which is a full-service platform for claiming the WOTC credit, Federal Empowerment Zone tax credits, and WOTC equivalent state hiring credits. She also manages our firm's business personal property tax compliance services for our Oregon region. So I appreciate their time and look forward to their comments. Moss Adams has been, just a quick intro into our long-term care practice and our healthcare practice. Moss Adams has been serving the healthcare industry for nearly 40 years, focused largely on long-term care, skilled nursing, retirement communities, as well as medical groups, community health centers, behavioral health organizations, and large hospitals and health systems. Our long-term care services group covers a broad spectrum ranging from traditional audit and tax work, but also strategic planning, risk and governance consulting, compliance, IT, and various operational service opportunities. We have over 200 professionals dedicated to our healthcare industry group. We're also proud to participate in a number of industry associations and are members of over 60 national and state healthcare associations, including the National Association for Home Care and Hospice, Leading Age, National Investment Center, and the American Healthcare Association. So today's Voice of Experience webinar is part of our ongoing health education series, so thank you for joining us. So today's agenda, we're going to talk about a few tax-saving strategies that we often find underutilized by long-term care and senior care organizations, and hopefully you'll find some value in some of these planning strategies. So some of the items that we're going to cover today are understanding the implications of the Protecting Americans from Tax Hikes Act of 2015, maximizing the IRS's new tangible property regulations, how we can better leverage cost segregation strategies, gaining a better understanding of energy tax credits and incentives, and finally taking advantage of the extension of the work opportunity tax credit and empowerment zone tax credits. And then we will wrap it up with some Q&A at the end, and if you have any questions along the way, please do submit them. So we're going to start out with a brief introduction of the PATH Act, which was signed into law December 18th of 2015. It says 16, but it's 15. And it included many popular tax breaks had expired at the end of 2014. So for them to be available for 15, Congress had to pass legislation to extend them. So that's what the PATH Act did. But it did a little bit more than that. Instead of extending the breaks for just 1 or 2 years, which Congress has been typically doing the last number of years, was of just extending these breaks for a year or two. The PATH Act actually makes a number of these breaks, popular tax breaks, permanent, and extends others for several years. But it's not all good news. There's a few PATH Act implications that only extend certain favorable impacts, like bonus depreciation through 2019, with a gradual reduction in the benefits. So just a few items that were made, popular items that were made permanent, was the enhancement of the 179 expensing deduction, various depreciation-related breaks for qualified leasehold improvement property that Jason will be diving into, a permanent extension of the R&D tax credit, as well as, we're not going to talk about it on this webinar, but the state and local tax deduction was made an extension permanently. So for those of you in one of 6 or 7 states in the country that has a sales tax, like Washington, that is a permanent deduction. A few of the popular tax breaks that are extended through 2019 include bonus depreciation, work opportunity tax credit, and the new market tax credit. And then a few that were extended through 16, empowerment zone incentives, and various energy incentives. And we're going to cover most of these in the coming slides. And then finally, it did delay, for what it's worth, I'll mention that it did delay a few Affordable Care Act provisions, including the Cadillac tax, which was delayed from 2018 implementation to 2020, as well as the medical device tax, the 2.3% excise tax on medical devices. It halted that for 2016 and 2017. So now, time for our first polling question. Which path are we on today? And you've got four opportunities to choose. So I don't see the results. There we go. Good. Most everyone got, majority got the right answer. Protecting Americans from tax hikes is the answer. So now I'm going to hand it over to Jason to dive into the tangible property incentives as it relates to the long-term care space. So Jason, go for it.
Thanks, Rob, and welcome everybody. As Rob mentioned, I'll focus on some of the tangible property incentives, a little bit about cost segregation, energy incentives, and so forth. So we'll get started with the first slide. What is tangible property incentives? A number of tangible property incentives are available to stimulate the economy through tax reduction related to timing differences. Cost segregation is probably one of the most well-known and beneficial tangible property incentive available. And what cost segregation does is the goal of a cost segregation study is to front-load depreciation, resulting in additional cash flow now and reducing tax liability. So it's really a tax deferral strategy to put more money in taxpayers' pockets today versus over a longer period of time. The PATH Act, as Rob kind of mentioned, of 2015, includes a number of different provisions. We're going to go through a little bit more in detail the differences as a result of the PATH Act and some of the benefits as well. We'll start with cost segregation. Cost segregation, as mentioned, is a tax deferral strategy. What we're aiming to do through a cost segregation study is identify a personal property that would otherwise be depreciated as non-residential real property or residential rental property, and recategorize those assets into a shorter depreciable life, whether it's 5-year, 7-year, or 15-year, and accelerate depreciation on those assets. A lot of times those assets will also qualify for bonus depreciation, which then obviously magnifies the benefit and the deduction in current years versus being depreciated over a longer time. A couple other benefits of a cost segregation study is identifying expense items. A lot of times we find that items that should be expensed are rolled into an overall project that ends up being capitalized and depreciated over a long time, or costs that are part of an acquisition should be expensed that are sometimes included in the basis for depreciation. Also identifies the TPR required units of property, and we'll talk about that a little bit in a couple more slides. But the results of a cost segregation study will essentially get taxpayers in compliance with the new tangible property regulations. Then obviously the value of the cost segregation is a time value of money benefit. Obviously having the dollars today versus having the dollars spread over a 39-year period is the true benefit of a study. So sometimes it's easier to look at it in a context of dollars and a graph. And in this scenario, I ran an estimate for a skilled nursing facility. New construction, $20 million total basis. Obviously, this can be scaled if you have a $10 million facility or even $5 million facility. Essentially, the numbers would be scalable to that basis. But in this scenario, I estimated 20% of the overall construction costs would be allocated to 5-year, 7-year, and 15-year asset lives, with the net benefit in the first year or increase in depreciation of first year being about $1.6 million. Over the first 5 years, an additional depreciation deduction of $2.7 million, and the net present value of $837,000. And the net present value is based on a 7% rate of return, and that's essentially determined over a 40-year period. Obviously, there's times during a 40-year or 39-year building that the rate of return would be higher or lower, but the average is somewhere around 7%. So typically, to determine the real value of a cost segregation study, you want to look at the rate of return and the net present value of the deductions, the tax deferral.
Jason, what would be some examples of assets that we would reclassify into these shorter life classes?
Yeah, good question, Rob. So when we're looking at a cost segregation study and we're looking at reclassifying assets, we're obviously, we're looking at the obvious categories such as carpeting being reclassified from a 39-year or 27.5-year life into a 5-year life, or identifying window coverings and so forth. Those are kind of the easy, low-hanging fruit, if you will. Cost segregation, the true benefit of a study is to dig into components that aren't necessarily easily identifiable. So there's electrical systems, plumbing, and mechanical systems that are in your building that support personal property. So the goal of a cost segregation study is to carve out as many of those items into a shorter life as possible. So when, for instance, if you're looking at a commercial kitchen, or any type of kitchen for that matter, there's obviously plumbing and mechanical that support the kitchen equipment. And the IRS has determined through years and years of case law that a portion of the electrical, plumbing, or mechanical systems that supports a piece of equipment that has a life of, let's say, 5 years, a portion of that system would take on the end-use life. So we identify, in the example of the kitchen, mechanical systems that support kitchen equipment and allocate a portion of that system to that piece of property. So moving on to the actual PATH Act and what's changed there, there's a number of pretty exciting things that changed as a result of the new PATH Act. Rob mentioned the 179 expensing limitations were permanently extended from the 2010 levels. What also was included in there is the air conditioning heating units could now qualify beginning in 2015 under 179. My understanding that prior to that, any type of air conditioning or heating units would not qualify, but they specifically identified these as being includable in 179 expense. 15-year property. There's obviously a lot of people on this call have probably heard about the qualified leasehold improvement property, qualified restaurant, qualified retail improvement property. All of these different incentives have been permanently extended. So, and they've been around for a number of years. Nothing's changed except for now they're permanently extended. Bonus depreciation, as Rob mentioned, is set to be phased out over the next few years. 50% we're currently sitting at for bonus depreciation is extended through 2017, and then it'll drop down 40% in 18, and then 30% in 2019, and then 2020 is set to expire altogether. One of the most exciting changes, and I would say that is going to be beneficial to a lot of taxpayers, is this new addition of the qualified improvement property. Essentially, it follows kind of the same guidelines as the qualified leasehold improvement property, whereas it's an improvement to an interior portion of the building that's non-structural. But where the difference lies is that whereas qualified leasehold improvement requires that there's a lease between non-related parties and the building has to be older than 3 years, the qualified improvement property does not have those same restrictions. So it could be a brand new building or a building that's less than 3 years old, and it can be between related parties. The life isn't 15 years, such as a qualified leasehold improvement. It still stays as a 39-year asset, but you're eligible to claim bonus depreciation on all those improvements. So it's a pretty good benefit that I would assume that a lot of owner-occupied properties will end up taking advantage of this, and it's a great benefit. But again, it's only for non-residential buildings, so it's going to be typically skilled nursing, assisted living that falls under the 27.5-year life will not qualify for the qualified improvement property bonus depreciation. And the final portion of the PATH Act that relates to tangible property anyway is the extension of the 179D energy efficient building deduction And not to confuse this with 179 expense, it's an entirely different incentive. And what this does is allows taxpayers to claim up to $1.80 a square foot for energy efficient building components added to buildings, either new construction or improvements. It's allocated between the HVAC system, the envelope, and the lighting system. Each of those systems equates to 60 cents a square foot. You can qualify for the total $1.80 a square foot for the entire building, or you can break it down into components. And the 179D building deduction is based on energy codes that were established in 2001. In 2016 only, they raised the baseline to 2007. So the IRS is starting to catch up a little bit with actual building code, but prior to 2016, buildings were essentially modeled based on 2001 energy codes, and I see a lot of properties being constructed, buildings constructed now that qualify for at least a portion of the 179D deduction.
Jason, one question. Maybe you could touch on, going back to that slide, the impacts of, and not to get into a too detailed of a discussion, but just to provide some perspective with regards to going back in time on some of these, as opposed to, so if you placed a property into service 5 years ago or a couple years ago, how would you benefit potentially from any of these or a cost segregation study?
Right, good question. And pretty much all of these incentives are available going back in time. Obviously, with the addition of the qualified improvement property being in 2016, there's not an opportunity to go back in time. But the IRS allows you to go back and essentially fix anything that anything that had not taken advantage of these provisions. So let's say you had a building that you acquired 5 years ago, and you capitalize it as 39-year property in your fixed assets. The IRS allows you to go back and essentially apply a cost segregation study and change depreciation from what you had originally depreciated at to what it should have been depreciated. So you're able to catch up all those deductions that you should have taken during that 5 years in the current year. And it's done through what's called an accounting method change. It's a pretty administratively friendly form to fill out. All the provisions that we're talking about here fall under what's called an automatic change. And so what that means is there's no requirement to get approval from the IRS. It's automatically accepted, and you can go back and change the depreciable lives on a number of items, or apply a cost segregation study, or in the example of the energy efficient building deduction, go back in time all the way back to 2006 and claim the energy deductions that you did not claim over time. So who's impacted? Provisions essentially benefit all taxpayers that make capital investments and want to reduce tax liability. So if you're building a building, likely you can benefit from one or a number of some of the incentives that we just talked about. The qualified improvement property, it does take a little bit of work. As I mentioned, it's for interior non-structural improvements, so there's a little bit of due diligence that needs to be done to determine what's structural versus non-structural, what's interior versus exterior. A lot of times we run into the issue of doors. You know, we replace all the doors in the building. Well, which door is an exterior door versus an interior door? And I know that's kind of splitting hairs, but based on tax law, the IRS only allows interior improvements to qualify as either qualified leasehold improvements or qualified improvement property. And this is a little bit repetitive, but you know, the benefits are obviously a reduction of tax liability, increasing tax flows, and the true value is really the time value of money, taking the deductions now versus over a longer period of time. We're on to our next polling question. This is a tough one, so hopefully everybody's been paying attention. In this presentation, qualified improvement property stands for, oh, I guess I just gave away the answer. QIP stands for Questionable Refund Program, Qualified Improvement Property, Qualified Retail Property, or Low Power Transmitter. So I'm assuming everybody's going to get this right, since one, I gave it away, and it's pretty evident by the answers of which one it is. So we'll give it a few more seconds, still see a few answers coming in, and we'll check the answers. So remember that to get CPE credit, you have to answer the polling questions throughout the presentation. So this is polling question number 2. And hey, everybody got it right. So it is Qualified Improvement Property. The other part, and I'll just kind of set the stage for this, and most people are very familiar with the new tangible property regs, so just give a little bit of the history behind it. I'm not going to spend a ton of time, but just want to talk a little bit about what has kind of transpired over the last decade related to the tangible property regulations. And as I mentioned, this has been in play for pretty much the last decade or so. And in for tax year 2014, the IRS required you to comply with the tangible property regulations. And for the purposes of this presentation, we'll look at building property. And really what the IRS did is it determined a number of different units of property related to building property, how to apply the improvement standards to determine whether it's a repair expense or a capital improvement. And then there's a couple other safe harbors and elections, which I won't really get into, but a number of taxpayers could essentially avoid compliance by falling within the small taxpayer. Safe harbor I shouldn't say avoid compliance. They could comply by falling into the taxpayer, and they didn't have to go through the whole accounting method change and all the other requirements for tangible property regs. So there's a couple of safe harbors here. But as I mentioned, I won't spend too much time talking about those. But what I do want to talk about is kind of the meat and potatoes of the tangible property regs and the differences between the old rules versus new rules. The old rules, when you made an improvement or you did something to a building, whether it was a repair or an improvement, you would look at the entire building as a unit of property and determined whether it was a improvement versus a repair from that perspective. As a result of the tangible property regulations and the identification of the unit of property, the IRS now kind of changed how you evaluate improvement versus repair and broke it up into 9 different building systems. So now when you're looking at capitalizing versus expensing, the work that's done needs to be compared to the specific HVAC system. So obviously the results being that there's a higher likelihood of capitalization, whereas before when you're looking at the context of the entire building, it was probably an expense. But on the other side of the coin, there's an opportunity to identify losses related to components that you had removed as a result of the improvement. So this is likely a recap on what you already have heard or know, but this kind of sets the groundwork for some recent revenue procedures that the IRS came out with recently. And so I'm not going to spend a whole lot of time on this, but when you're looking at the units of property, you have to look at it from and apply these improvement standards, and it's typically referred to as the bar test. Whether you're making that unit of property better, adapting it to a new use, or it's a restoration. There's a couple of bullet points here that kind of help guide you through that, but it's definitely not black and white. The IRS issued a number of examples, which again aren't, they provided a little bit more guidance than what was previously in play, but nothing that's necessarily black and white. So really when you're looking at improving a property, you have to apply the SPAR test. If it doesn't meet one of these criteria, there's a opportunity to potentially expense it as a repair versus capitalizing it and identifying a partial disposition.
Jason, what might be a common example in a skilled nursing or long-term care facility?
Yeah, so we've seen a lot of work related to the tangible property regulations over the last year or so, 2 years. And typically what we see is it runs the gamut, but a good example would be a taxpayer owns a building and they tear off the roof of the building or replace it with a new roof, and they're taking it all the way down to they're taking all the plywood off, all the shingles off, and just down to the rafters, if you will, and put a new roof on. Under the old rules, you would look at the replacement of the roof and say, okay, is this an improvement to the unit of property, being the building and all of its systems? You might be able to get to the answer that no, it is not an improvement to the building. Versus now under the new unit of property rules, you have to look at it in the context of just the shell itself, so the walls, the roof, and the floor. So you're probably going to get to a point where it would be a capital improvement, and then on the other side of that, you would end up capitalizing the roof, and then you would be able to identify a partial disposition related to the roof that you tore off. So under the old rules, if you had determined that it was an improvement and you capitalized it, you would essentially have 2 roofs being depreciated over the life of the building. And obviously there isn't 2 roofs in service, so under the new regs, you're allowed to go back and identify a value for that roof that was tore off and recognize a loss on that. The other thing we see a lot of is work done to asphalt paving parking lots. To the extent that you're seal coating a parking lot, it's likely a repair versus going in and totally grading and taking all the asphalt out and repaving. So we see a lot of repairs related to just seal coating. See a lot of repair opportunities within the building related to maybe changing out a sink or replacing one sink in an entire facility. So there's definitely, like I mentioned, runs the gamut. But we see, for the most part, roofs are kind of the big thing that we saw a lot of over the last year and a half. So that gets me to what's new. So the IRS recently, and this is kind of hot off the presses within the last 2 weeks, issued Revenue Procedure 2016-29. What that says is it basically allows taxpayers who filed an accounting method change to go back and file another accounting method change to either add repairs or pretty much anything except for partial dispositions that they had left on the table as a result of maybe timing. They had to just get it done. So taxpayers filed a 0 value accounting method change or reduced amount. This allows taxpayers now to file another accounting method change rather than being locked out for 5 years, and which is huge because some taxpayers just didn't have the time to comply and just filed the method change as required. But what it does not allow taxpayers to go back and file accounting method changes related to partial dispositions, kind of that roof example. If you had done that back in time, there's no opportunity to go back and claim those partial dispositions in prior years. That was kind of lost with filing your 2014 tax return. But everything else is back in play now, and there should be a ton of opportunities related to repairs that are capitalized that should have been expensed. Ghost assets are another one. Material supply acquisition costs as well. And then a recap, kind of next steps. So obviously a number of exciting things are happening with the PATH Act related to tangible property and capital improvements. Taking advantage of the qualified improvement property in 2016 is going to be very beneficial to taxpayers. when you're looking at digging into tangible property regs, qualified improvement property, energy efficiency studies, it's always good to consult with a professional. Cost segregation is professionals obviously dig into these areas, and we spend a ton of time focusing on tangible property, allocating purchases and new construction into shorter depreciable lives to provide the most benefit to taxpayers. So feel free to reach out if you have any questions. And with that, I believe we are on to the hiring credits.
Thank you, Jason. So now we're going to shift gears a little and discuss 2 federal hiring credits that were recently extended as part of the PATH Act. And then we'll also touch just a little bit on a couple WOTC equivalent state-level hiring credits that may also be available. So the first hiring credit we're going to talk about is the Work Opportunity Tax Credit. This is also referred to as WOTC. It's a federal hiring income tax credit where the credit is calculated based on a percentage of certified employee gross wages. While this is a federal credit, it's administered at the state level by state coordinators who verify and certify the credit. The purpose of the WOTC ultimately is to provide an incentive for businesses to hire individuals who have been deemed statistically at a disadvantage for employment and to help get them back into the workforce. In order for an employee to be deemed at a disadvantage for employment, they must qualify under one of 14 different targeted groups. So to kind of give you a couple examples of a targeted group, food stamp recipients, TANF recipients, TANF is a form of welfare, and veterans. So, a lot of businesses feel that this could be seen as discrimination, but it is actually the full purpose and intent of the program. The IRS is strongly encouraging businesses to screen their applicants and then to hire those that qualify for WOTC over those that do not.
MaryCaitlin, what's the risk? Is there much risk at all from a discrimination standpoint?
There is not. In most cases, businesses will use an outside provider to screen the employees for the WOTC credit, which essentially takes the employer out of knowing how an employee is qualifying for the credit. So employers can significantly reduce any potential risk by doing that. So in addition to the targeted groups, only brand new employees may be eligible. And this is to alleviate businesses from hiring and subsequently rehiring the same employee to try to maximize the credit. In general, this is a 1-year credit per employee, so meaning the credit can only be calculated for each certified employee based off of their first year wages only. It is also considered a prospective program. It does have a 28-day statutory filing deadline, and that's per qualified employee. So the 28-day countdown begins on the employee's hire date. So when you file the qualified employee's paperwork, state coordinators will review the information, they'll verify the qualification, and then they'll issue a certification to the business, which is essentially your ticket to start calculating the credit. Additionally, qualified and certified employees must work at least 120 hours in order to begin generating credit. So if an employee works less than 120 hours prior to termination, then their wages become ineligible for calculating the credit. So as part of the PATH Act, WOTC was extended for 5 years. This is retroactive to January 1 of 2015 through December 31 of 2019. And this is really significant for WOTC because historically we've only received 1 to 2 year extensions, which it subsequently expires before it gets extended. So this is huge to have a 5-year extension. All companies hiring qualified employees are able to screen for WOTC going forward until December 31, 2019, but keeping in mind that 28-day filing deadline. And in addition to the extension, a new target group was added. This target group is long-term unemployed, also referred to as LTU. It was created to capture a wider range of individuals who statistically have struggled to get back into the workforce. This is also really exciting, as it is the first time since 2012 that a new target group has been added to WOTC. So the new long-term unemployed target group became effective for new hires beginning January 1 of 2016. And for an employee to qualify, they must have been unemployed for at least 27 consecutive weeks, which is about 6.5 months, prior to employment, and then at some point during that period of time, they received unemployment benefits from either a federal or a state agency. Additionally, for this target group, the maximum available credit that can be calculated per certified employee, obviously based on their gross hours and gross wages, is $2,400. So WOTC previously had expired in December of 2014, and all throughout 2015 we were waiting for an extension of the legislation. And because of that, many businesses stopped timely screening and filing paperwork for WOTC because of their concern over spending the resources for an opportunity that really was not guaranteed. So since the PATH Act was extended in December of 2015 and included, a WOTC extension, the IRS is allowing what's called a transition relief opportunity for businesses who did not timely screen and file and waive that statutory 28-day filing deadline and retroactively screen all brand new hires beginning January 1 of 2015 through May 31 of 2016. And then the filing deadline for those applications for qualified employees is June 29th of 2016. And then any new employees hired after May 31, so beginning June 1, they become subject to that 28-day filing deadline. So WOTC is considered a general business credit. It's available to be claimed in the year certifications are issued by the state coordinators. Since this is a general business credit, it has a 1-year carryback and a 20-year carry forward. The amount of credit generated may offset 100% of alternative minimum tax and 100% of regular income tax. Also, the maximum credit amount can range from $2,400 even up to $9,600 per qualified and certified new hire, depending on which targeted group they are certified under. There is also no limit to the number of certified employees you can claim the credit for. Any unused credits just get carried forward to a future year. So on your screen, this is a list of all of the current targeted groups under WOTC. And a new employee could qualify under any of these. There are a total of 14. And as you'll see at the bottom, there are 5 targeting veterans. Not all of the target groups have the same maximum credit amount. You can see they vary, but obviously the veteran target groups have some of the larger maximum credit amounts. And almost all of these are for 1-year credits. There is one target group that does allow for 2-year credit. That is the long-term TANF recipient. So as I mentioned before, TANF, it's a form of welfare. And employees who are certified under this target group, so it's a total amount of $9,000. And how that's broken up over the 2 years is in year 1, the maximum amount available is $4,000. And then in year 2, it's $5,000 for that total $9,000. Nonprofit long-term care organizations, they may also be eligible for WOTC, but they're limited to only benefiting from hiring qualified veterans. So as mentioned on the prior slide, there are 5 different targeted groups for veterans that they could qualify under. The credit calculated may be used to offset the Social Security taxes, but just a note, they cannot be used to offset any unrelated business income tax. Based on our experience with long-term care organizations, WOTC can be really substantial, regardless of the size of the organization. So on your screen, there's a couple of examples of clients that we've worked with for the past 2 years, and I'll just go over these quickly. The first one is Organization A. So they have about 10 locations. So they have 717 employees that they screened in the last 2 years. Of those, 58% ended up qualifying for WOTC, and then subsequently 66% of those were certified. Their average annual credit over the last 2 years was $105,000. So that was per year. And then Organization B, they have 93 locations. They screened 5,147 employees over the last 2 years. 25% of their employees qualified, and subsequently 63% of those were certified. And their average annual credit over the last 2 years was $312,000. And like I said, that was each year. So it can be very substantial regardless of size. Okay, we've reached our third polling question. So as mentioned before, when you make your selection, make sure you hit submit in order for your answer to be considered. And the question reads, what is the range for the maximum available WOTC a business may claim for a new certified employee? We've got 4 answers to choose from. We've got $3,000 to $8,600, $2,400 to $9,600, $2,000 to $9,800, and $1,400 to $9,600. We'll give you a few seconds to make your selection. All right, so we're going to close the polls. All right, 71% if you got the answer right, $2,400 to $9,600. So the second hiring credit extended in the PATH Act is the Empowerment Zone Tax Credit. This is also a federal hiring income tax credit where the credit is calculated based on a percentage of qualified employee gross wages. It's an incentive for businesses located in federally declared distressed communities to encourage economic growth and reduce unemployment. So for any employee to qualify, they just need to live and work in that same zone. And unlike WOTC, this credit can be taken each year the employee is retained and continues to live in the zone. So once the employee moves out of the zone, but is still retained with the business, you can no longer calculate a credit based on their gross wages. So empowerment zones were extended for 2 years, retroactive to January 1 of 2015 through December 31, 2016. And the map on your screen showing you in the states that are highlighted in dark blue, those are the states that currently have at least one empowerment zone. And keep in mind, empowerment zones are federally declared distressed areas, and they can vary significantly in size. Additionally, a state can have one empowerment zone or potentially up to 7 different empowerment zones.
MaryCaitlin, how do you know whether your organization is in an empowerment zone or not?
So there's the HUD, Housing and Urban Development, they kind of manage the empowerment zones. They have a locator tool, but there's a much better user-friendly tool through Google. If you just type in Empowerment Zone Locator Tool, they have a very interactive map where you can enter in the physical address of your location, and then it will return a result indicating if it does or does not fall within an empowerment zone. So similar to WOTC, this is a general business credit. It's available to be claimed for each qualifying employee in the year they generate credit. And as mentioned before, general business credits allow for a 1-year carryback and 20-year carry forward. The amount of credit may offset 25% of alternative minimum tax and then 100% of regular income tax. And unlike WOTC, there are no certification or filing requirements. The employee just needs to live and work in the zone. And then the maximum credit amount for empowerment zones is $3,000 per qualified employee each year. And as I mentioned before, but I just want to repeat, there is no limit on the number of qualified employees you can claim the credit for. Any unused credits get carried forward to a future year. Okay, we reached our last polling question, and this should be pretty easy. So the question reads, to qualify for empowerment zone tax credits, employees must live and work in the zone. So you've got 2 choices, true or false. We'll just give you a few seconds to answer this since it should be pretty easy. And as I mentioned before, don't forget to hit submit so your answer is considered. We'll give you about 5 more seconds. All right. So, perfect. Everyone got that right. I appreciate it. So the answer was true. And over the last few years, many states have started piggybacking off of WOTC and creating state-level hiring credits that have similar qualifications. An example of this is the Washington State Veteran Hiring Credit. It becomes effective October 1, 2016 for new employees. It's an incentive to hire unemployed veterans specifically, and this is a one-time credit per employee that may be used to offset public utility or business and occupation taxes in Washington. The credit may be worth up to $1,500 per qualified employee, and like the other credits we talked about, it's based on a percentage of the qualified employee's gross wages. And just quickly to show you some additional states that have hiring credits similar to WOTC, these 3 states do focus on veterans. Alaska, they have an income tax credit of up to $3,000 for qualified veterans. Illinois offers an income tax credit of up to $5,000 for each year you have a qualified veteran. And New Mexico offers an income tax credit of up to $1,000 for the first year for a qualified veteran. So these are just to give you some examples of other WOTC equivalent state hiring credits. So please, feel free to contact us if you want to see if your business may benefit from WOTC or the Empowerment Zone tax credit. And then, of course, we can also help identify if you may be eligible for any WOTC equivalent state hiring credits in addition to these federal hiring credits.
Okay, looks like that was great, Jason, MaryCaitlin. Thank you. Looks like we've got a few minutes for any kind of questions, and I believe we've got a couple. One question that came in for MaryCaitlin would be, can an employee qualify for both the WOTC and the Empowerment Zone tax credit?
So this is a good question. An employee can qualify for both, but based on the rules for the general business credit, you take the work opportunity credit first on the gross wages, and then whatever remaining gross wages that were not used to calculate the WOTC can be used to calculate the empowerment zone in that first year, and then any future years where WOTC is no longer applicable, then you can take the empowerment zone.
Great. We have another question with regards to Section 179D, energy incentives, so this would be for Jason. Maybe Jason, explain how it works. I mean, it's not necessarily a credit, but how exactly does the energy work?
Yeah, so there's an additional energy efficiency deduction. Essentially, it's a bonus depreciation for energy efficient components that would have otherwise been categorized as buildings. So it only relates to non-residential real property. It does, in limited scenarios, apply to residential rental property, but it has to be for buildings that are 4 stories or greater. So typically we see it on non-residential buildings, and it requires a modeling based on the building standards, as I discussed earlier, and a certification process. Once that is completed and the energy efficiency is determined, then it gets applied on your tax return. And as Rob mentioned, it's a deduction and almost takes on the same, or has the same impact as essentially 100% bonus depreciation for those energy efficient components.
Okay. Another quick question for Jason. Would an improvement to framing and drywall, ceiling, and plumbing systems qualify for the qualified improvement property opportunities?
Yeah, so it's any interior non-structural improvement to a non-common area. So typically we see that in buildings where there's a elevator lobby or the general common areas for the main lobby to an office building. But in the context of a senior living facility, the framing, drywall, ceiling, and plumbing systems would likely all qualify as qualified improvement property. When you get into structural framework, it likely would not qualify. Or when you're talking about HVAC systems, the air handlers on a roof wouldn't qualify, but the duct worked inside the building would likely qualify.
Okay. We're going to I think we got time for another question. We'll bounce back to MaryCaitlin. Why aren't all qualified applications, from a WOTC standpoint, why aren't all qualified applications certified by the state? Looking at your percentages, they weren't all qualified. Why is that?
So this is a really good question. And essentially how you determine qualification for an employee is you have the employee complete a survey. So they have to answer a series of questions. And basically what they answer is what you go off of, and sometimes they erroneously answer by accident. Sometimes the states struggle to be able to verify the certification or verify the information. Typically, if you're using an outside provider, they have a denial appeal process, so they can increase the number of certifications for qualified employees. But because you're having the employee fill out the information and sometimes they misanswer, that is a big reason why not all qualified employees end up being certified by the state.
Perfect. Thank you. Well, I think that gets us to the end. I appreciate everyone's participation from our presenters, and I appreciate everyone that joined our Moss Adams webcast this morning, and be on the lookout for more. On your screen, you'll see the contact information for myself and Jason and MaryCaitlin. Feel free to reach out to any of us if you have any further questions with regards to the content that we've presented here. And at this point, I will pass it back to Emily Bright to close it out.
Great. Thank you, Rob, and thank you, Jason and MaryCaitlin, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive credit. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE icon at the bottom of your screen. Open the icon and click the printer in the lower right corner to download a PDF copy of your certificate. I'll keep the console open for a few moments to allow you to do that now. A copy of your CPE certificate will be emailed within 2 weeks should you have any difficulties now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.